Yeah, well, we just got a rate cut by the Fed, and that didn't seem to be the trigger. I think we're going to get another rate cut, despite the fact that Powell kind of said it wasn't a lock. The markets kind of priced it in, and he kind of pushed back against that. But at the end of the day, I think there's going to be another cut, because I think the economic data is going to continue to disappoint. Now, we're not getting as much data as normal because of the government shutdown, but it's possible that they end that government shutdown and we get a deluge of bad economic data that could be a catalyst for another move up, in the price of gold, as people start to, factor that in. And the Fed, at its last FOMC meeting, announced that QT is officially ending in December. So I think another big catalyst will be the launch of the next round of quantitative easing, which I believe is coming. I thought it would have actually happened already, so I'm kind of surprised they were able to make it through the entire year without doing it. But I think 2026 will be the year that they, crank up the presses again, especially if they continue to see weakness in the longer end of the bond market. And then, of course, you do have, some court decisions, on the tariffs, on the firing of Lisa Cook. I think that could have implications for the dollar and for gold.
So do you think quantitative easing starts under Powell, or do we wait until his term is over? We've got this new Fed chair in that's probably going to be more Trump aligned. How are you seeing it?
Yeah, it's hard to say. I forget when does Powell leave? Midway through the year, May? I guess it's about 50-50 that, they can hold off on QE. It kind of depends on what happens. But I think if you start to see a big move down on the stock market or something that might scare the administration, there'll be a lot more pressure. And we'll see. Today, we're getting a decent decline in stocks. I know Bitcoin, broke below 100,000 for the first time in about 4 months. And that could be a bit of a leading indicator that, people are starting to take risk off. And it may not just be crypto. It may be a broader-based risk-off trade, which also could see some money flowing back into gold as a safe haven investment. And I think as the air comes out of the Bitcoin bubble and people begin to question the digital gold narrative, which they should, because it's just a meme, to the extent that people wake up to the reality that Bitcoin isn't digital gold, well, then maybe they'll buy real gold instead. And so there could be a source of some extra gold buying from people who either get out of Bitcoin or, instead of buying Bitcoin, decide to buy the real gold, right? Instead of some fake version of it.
When you look at the U.S. economy, how bad are you thinking it could get? What's your vision there?
Well, I think things are pretty bad. If you look at the most recent polls on Trump's approval, his approval on the economy is the lowest it's been of either of his presidencies. He only has a 30% approval rating. So that's not even like all the Republicans. And over 60% disapprove of his handling of the economy, right? Just the economy. That's supposed to be his strong suit, right? And, Trump is going around, touting how we have the strongest economy in the history of the country, right? We have the hottest economy in the whole world. And he contrasts that to the Biden economy, which, we had last year. And he said that was the worst economy in the history of America. So apparently, in less than a year, we've gone from the worst economy in the history of America to the greatest economy in the history of America. Yet the voters don't approve of his handling of the economy. So somebody's not, telling the truth, right? Either the public loves the economy, but they're afraid to be honest with the polls, or that's one area where I trust the public. I don't trust their opinion on a lot of things, but I trust them to know how they're doing themselves. Because when they're asked about the economy, they're not talking about the overall unemployment rate or inflation. They're talking about their own individual circumstances, right? And so they're answering that question based on what they're experiencing in their own lives. Are things getting better for them financially? Are things getting worse? So people know, their own circumstances, right? Yeah, well, I think the people at this conference are among the few people that are protecting themselves. They are at a gold conference, right? So everybody at this conference, I'm sure, has some gold, has some silver. They own some mining stocks. So the people here are not the ones that need protection. It's the people who didn't come here, that have no protection. Now, some of them may think they have protection because they bought Bitcoin. But Bitcoin, they're going to find out, is probably riskier than all the stuff they were worried about. They're going to end up losing more money in Bitcoin than if they would have just stayed in the S&P 500. But I think most people, especially retirees or near retirees, need to understand the risk of inflation and the devaluation of the dollar, and they need to do something about it. They should be buying gold and silver. I got Schiff gold, right? They could buy from me. They could buy, someplace else, but people have to own physical gold and silver, and they should have an investment portfolio that reflects the reality of what's going to happen to the dollar over time and the value of U.S. assets. And people need to invest globally. I mean, we've been investing for clients in international dividend-paying stocks. If you look at our core dividend payer strategy, year to date, it's up about 50%. Which is a phenomenal return. This is probably the best year we've had in the 11 or 12 years that I've run the strategy. It's about triple the S&P. Most years the S&P has outperformed the strategy, but now this strategy is destroying S&P. And I think this is the beginning of a major rotation out of U.S. stocks back into global stocks. So I don't think what happened with our strategy in 2025 is going to be a one-off year. I think it's the beginning of a trend that's going to last for many, many years. And so people should recognize this change and start moving money out of the U.S. stock market and investing in the markets that we're investing in our global strategies, because the valuations are much better, the dividend yields are much higher, and you get the tailwind of a weakening dollar, which I think is going to strengthen over time. And that's going to be one of the main reasons that foreigners are going to start pulling out of our markets, because they're going to have a headwind. They're going to be losing on the foreign exchange, and that's going to be subtracting from the returns on U.S. assets. So they're going to want to divest. And it's been foreign buyers at the margin that have really helped power the U.S. market for the past 10 years. And now they're going to be selling instead of buying.
We just got another rate cut from the Federal Reserve, and once again, it didn't move the needle the way people expected. That alone should tell you how far gone this economy really is. A few years ago, a Fed rate cut was like a shot of adrenaline for the markets. Everything would spike higher. Stocks, crypto, real estate, you name it. Now rate cuts are met with a shrug. That's not a sign of strength. That's a sign of exhaustion. It means we've reached the point where cheap money doesn't fix anything anymore. The patient is on life support and they're out of drugs that work. Powell tried to sound tough. He said the next rate cut isn't a lock. He wanted to project some kind of control, but the market's already called his bluff. Futures are pricing in another cut, and they're probably right. Because despite the Fed's spin, the data's going to keep disappointing. The only reason it hasn't looked worse is because half the government's statistical apparatus has been shut down. Once that reopens and we get the flood of delayed reports, it's not going to be pretty. And remember, the Fed already told us that quantitative tightening ends in December. That's the quiet admission of defeat. They spent 2 years pretending they could unwind the balance sheet and normalize the system. Now they've thrown in the towel. The next phase, and you can write this down, is quantitative easing. Not maybe, not sometime. It's coming. 2026 will be the year they crank up the printing presses again. I'm actually surprised it hasn't started already. I thought by now they'd be knee-deep in QE5, but somehow they've managed to paper over things long enough to keep it together. Maybe it's political. Maybe they don't want to admit the economy's in trouble before an election year. Maybe they're trying to kick the can just a few months further. But the bond market is starting to revolt. Yields at the long end are creeping higher even as the Fed cuts rates. That's the market saying, we don't believe you. We see the debt and we see the inflation risk. That's what happens when you print trillions out of thin air and call it policy. You destroy confidence. The next QE program won't be about stimulating growth. It'll be about survival. They'll do it because they have to, because the government can't fund itself without it. Trillions in new debt, soaring interest costs, and a shrinking pool of foreign buyers. Someone's got to buy those treasuries, and the only buyer left is the Fed. We've been warning about this for years. They told us inflation was transitory. They told us deficits didn't matter. Now we're at the point where the entire U.S. economy depends on Continuous credit creation. It's a treadmill we can't get off. You want to know how bad things really are? Look at public opinion. Trump's approval rating on the economy is the lowest it's been in either of his terms, around 30%. Over 60% disapprove of his handling of it. And this is supposed to be his strong suit. He's out there claiming we have the greatest economy in history, right after saying Biden gave us the worst economy in history. Apparently, we went from the worst to the greatest in under a year. The voters aren't buying it because they don't need CPI charts or GDP growth rates. They feel it in their wallets. That's the thing politicians never get. When you ask Americans how the economy's doing, they're not quoting macro data. They're talking about their lives. They're looking at their grocery bills, their rent, their insurance premiums, their credit card balances. And by those measures, this economy is not strong. It's a debt-fueled illusion, and people know it. That's why gold is where it is, and why it's going much higher. Look, the people at a gold conference like this one, you're the exception. You're the ones actually taking steps to protect yourselves. You own real money. You've got gold, silver, maybe mining stocks. You're not the problem. It's everyone outside this room who's vulnerable. The average retiree, the average 401k investor. They think they're diversified because they own an index fund and a few tech stocks. They have no idea what's coming.
Well, even, characterizing it as a pullback, I mean, we're at 3,950 as we're talking. We've only pulled back from a level that we reached for a day, right? We had a quick move up, but the fact that we're just below 4,000 doesn't really feel like it's a pullback. It's only a pullback in relation to the fact that we almost hit 4,400, which was crazy in that it only took us maybe a week to get there from hitting 4,000. So if you throw that week or two out and just look at where we are, we've gone up a lot on the year. And I think sentiment, it's interesting how such a sharp decline can turn the sentiment to get everybody thinking that this is now potentially a bear market already in gold, and that there's a lot of downside risk. I think that's kind of what the market was trying to do in shaking out some of the newer entrants that may not really have the conviction, or maybe came in with some leverage and have been flushed out of the market. But we've created a lot more nervousness so that we can climb that wall of worry. And so as far as I'm concerned, if this is a correction, it's probably already over. I don't think there's that much downside in the price of gold from here. And the same thing with silver. I mean, silver didn't hold above 50, but it did take out 50, which is something it never did really in 1980 or 2011. We got almost to 55, and now we've had a pullback, but we're holding 48.50, which if you told people even a few months ago silver would be at 48.50, they wouldn't be, oh my God, it's pulling back. They'd be very happy that silver was at this price, and especially the gold miners. I mean, gold pulling back to 3,900 is great for all these gold mining companies. They're making a ton of money at $3,900 gold. They're making a lot of money at $2,900 gold, and that never really got factored into the price. I just think we're early in a broader bull market. I think that investors, mainstream Wall Street investors, both institutional and retail, are just finally noticing gold and deciding that they should make it a part of their portfolio. And this is after, gold is up 11, 12x this century. The Dow is down, close to 70% priced in gold since peaking in 1999. So gold has outperformed the markets, yet investors haven't even noticed that really until just recently. And I don't think that the fact that they've now decided that gold should be included in a portfolio, whereas before it had no place in a portfolio, I don't think that is going to change because, oh my God, now gold's 3,900 and not 4,300. I think you're going to start to see more accumulation of gold from investors who never bought any. And I think the central banks that have been the drivers for the past couple of years, I think they're actually going to pick up the pace of their gold buying. I think more central banks that weren't buying gold are now going to start buying as well. So I think there's a lot of new demand coming from gold, and I don't see a lot of new supply. I mean, there's some, but not nearly enough.
We've reached the stage where everything the Fed does makes the problem worse. They cut rates, inflation ticks up. They hike rates, debt service explodes. They try to shrink the balance sheet, the bond market convulses. They try to expand it, the dollar tanks. It's lose-lose. That's what happens when you spend decades manipulating interest rates and blowing bubbles. Eventually, there's no painless option left. That's why quantitative easing isn't just inevitable. It's destiny. QE is the only play they have left, but this time it won't be a stimulus. It'll be a rescue mission for a dying currency system. And let me be clear, when QE returns, gold will not just rise, it will reprice. Because when a central bank publicly admits that it can't normalize, that's a confession of systemic insolvency. QE is not a sign of strength. It's an admission that the system can't survive without life support. We're heading into a world where central banks print to fund governments directly, where deficits are monetized as a matter of policy, where the line between fiscal and monetary is erased. That's not modern monetary theory. That's old-fashioned collapse. Once that happens, there will be no hiding place in paper assets. Bonds will lose value as real yields stay negative. Stocks will lose purchasing power even as nominal prices rise. The only assets that will preserve wealth are the ones that can't be printed. Gold, silver, productive land, and real businesses that produce tangible goods. This is what I've been saying for 20 years. You can't print prosperity, you can only counterfeit it, and eventually the bill comes due. Now let's talk about the psychology here, because the irony is, even as all of this unfolds, most investors are still complacent. They've been conditioned to believe that the Fed has everything under control, that no matter what happens, the Fed will fix it. But they don't understand that the fix is the problem. Every fix requires more money creation, more debt, and more inflation. And the market knows it. That's why gold's rising even when rates rise. That's why the yield curve stopped mattering. The old relationships have broken down. Gold is no longer reacting to short-term rate moves. It's reacting to the long-term realization that the system itself is unsound. Now, you want to talk about an indicator that tells you where the smart money's going? Look at central bank gold purchases. They're not buying because they want to make a trade. They're buying because they understand the endgame. They know that the world is de-dollarizing. The BRICS bloc is developing its own payment systems backed by commodities. Nations like China, Russia, India, and Saudi Arabia aren't waiting for permission from Washington. They're already building the alternative. Meanwhile, Western central banks are quietly joining the game. Even the European Central Bank, which once viewed gold as irrelevant, has started increasing its reserves. This is the global vote of no confidence in the dollar. And while all that's happening, the Fed's balance sheet will soon start ballooning again. That means more inflation, not less. Sure, they'll massage the CPI numbers, just like they always do, but the average American doesn't need a PhD in economics to see what's happening. You can't fake the grocery bill. You can't hide shrinkflation. You can't spin the fact that the average family can't afford a house without a 40-year mortgage. That's why the public's faith in this booming economy is crumbling. The government says unemployment's low, GDP's strong, inflation's cooling. Yet 60% of Americans say they're worse off financially than a year ago. That's not a messaging problem. That's a reality problem. We've entered the twilight of the dollar standard. It's not going to collapse overnight. It's going to erode year by year as confidence drains away. First, foreign creditors lose faith, then domestic savers, then institutions. At each stage, the exit gets narrower. The people who see this coming, who act early, will survive it. The ones who wait for CNN to tell them it's a crisis will be too late. That's why I keep hammering on owning physical gold and silver. Not ETFs, not paper contracts, not synthetic exposure. Real, tangible metal you can hold outside the banking system. Because when the next round of QE hits, the financial plumbing will clog. Counterparty risk will skyrocket. And if you think your broker's going to let you withdraw metal when everyone's panicking, good luck. I tell people all the time, you don't buy gold to get rich. You buy gold because you understand what's about to happen. It's not speculation, it's self-defense. And for investors looking for yield, there are better options abroad. That's why I'm so bullish on international dividend-paying stocks. These companies are real businesses with real cash flow, operating in economies that still produce things. Our core global dividend strategy, up over 50% this year, is living proof that you don't need to gamble on U.S. tech stocks to make money. This is the beginning of a long-term rotation. Money will flow out of the overvalued, overleveraged, overhyped U.S. market and into value-driven, cash-flowing assets overseas. It's not just about valuation, it's about currency. A weakening dollar is a tailwind for international investors and a headwind for anyone stuck in dollar-denominated assets. The world is rebalancing away from U.S. dominance toward a multipolar system, and gold is at the center of that transition. Now, for those who still think they can hide in Bitcoin, good luck. Bitcoin is not digital gold. It's not a hedge. It's a speculative tech bubble masquerading as one. You can't have a stable store of value that drops 40% in a week every time liquidity tightens. Real money doesn't need hype or hashtags. Real money doesn't depend on someone else's software. I get it. The idea of digital gold is appealing, but reality doesn't care about narratives. And when the next liquidity crisis hits, Bitcoin will get sold just like everything else. The hodlers will discover that diamond hands melt under margin calls. The real safe haven isn't a line of code, it's an ounce of metal. So yes, the next Fed chair might be more Trump-aligned, but that won't change the math. No one can fix this without massive pain. No politician is going to stand up and say, we need a depression to cleanse the debt. They're going to print. They'll always print. That's why gold is not just insurance, it's inevitability. And when that next QE program launches, don't be surprised when the headlines read, gold hits $5,000, silver breaks $100. Because by then, it won't be a bubble, it'll be a repricing of reality. Remember, you don't wait for the fire to start before you buy insurance. You buy it because you see the smoke. The smoke's everywhere now.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.